Welcome to this video on the fundamentals of finance. In this session, we will explore key concepts that form the basis of financial decision-making for individuals and businesses alike. What is finance? Simply put, it involves how people and businesses evaluate investments and manage their money. This includes activities like borrowing, lending, saving, and budgeting. Finance is generally categorized into three types: personal, corporate, and public finance. Finance addresses three fundamental questions: what long-term investments a firm should make, known as capital budgeting, how to raise the necessary capital, and how to effectively manage day-to-day cash flows through working capital management. There are three primary forms of business organizations: the sole proprietorship, the partnership, and the corporation. Each structure has distinct implications for liability, control, and access to capital. A sole proprietorship is owned by a single individual who holds all profits, but also bears full responsibility for all debts. This means there is no legal separation between the business and the owner, potentially putting personal assets at risk if the business is sued. A partnership involves two or more co-owners. In general partnerships, owners face unlimited liability. Limited partnerships, however, distinguish between general partners who manage the firm and limited partners whose liability is restricted to their specific investment. A key challenge for partnerships is that the business's life is often tied to the general partner. Transferring ownership can be difficult and often requires forming an entirely new partnership, whereas limited partners can transfer their shares more easily. Corporations are the preferred form when large sums of money are required. Legally, they exist separately from their shareholders. This structure limits the owner's liability to the amount of their investment and ensures the firm's life is not tied to the status of individual investors. In a corporation, shareholders elect a board of directors, who then appoint management. A notable drawback of this structure is the double taxation of earnings when they are distributed to shareholders as dividends, creating a trade-off between corporate benefits and tax obligations. The principal goal of the financial manager is to maximize shareholders' wealth, which is often reflected in the company's stock price. This alignment ensures that investment decisions contribute positively to the firm's overall value. Take Apple as an example. When Tony Fadell proposed the iPod in 2001, successful implementation of that investment, combined with efficient funding, ultimately led to a significant increase in the firm's stock price. Financial managers must balance capital budgeting, capital structure, and working capital decisions. By making choices that directly impact shareholders' wealth, they fulfill their primary objective of maximizing value. Companies like Coca-Cola illustrate the need for sustainable growth. This involves balancing profit and returns for shareholders, with responsibilities toward their people, their product portfolio, their partners, and the planet. Ethics are fundamental in finance. Since business relies on trust, ethical conduct is not just morally correct, but essential for long-term success. Unfortunately, history is full of examples where ethical lapses damage trust and business viability. To summarize, there are 5 basic principles of finance. Money has a time value. There is a risk-return trade-off. Cash flows are the source of value. Market prices reflect information, and individuals respond to incentives. Our first principle is that money has a time value. Essentially, a dollar received today is worth more than one received in the future, because today's dollar can be invested to earn interest, growing your wealth over time. Next, we have the risk-return trade-off. We generally avoid additional risk unless we expect higher returns as compensation. Because investors are typically risk-averse, riskier projects must offer a greater expected reward to attract capital. Third, cash flows are the true source of value. While accounting profit is a useful metric for performance, it differs from actual cash flow. We focus on incremental cash flows to determine the true value of a business decision. Fourth, market prices reflect information. In efficient markets, prices respond rapidly to new data. Good news tends to drive stock prices up, while bad news or poor decisions can lead to a decline. To see this in action, consider the 2005 incident involving Nike. When news broke of their CEO's plane having mechanical trouble, the stock price dropped immediately, only to bounce back once it was confirmed that the plane had landed safely. Our final principle is that individuals respond to incentives. This often leads to the principal-agent problem, where a manager's interests may conflict with those of the shareholders. This can lead to differing preferences regarding risk and debt. To mitigate these agency costs, firms use various measures. Compensation plans are designed to align managerial interests with shareholder wealth, while external monitoring by auditors, credit agencies, and analysts keeps management accountable. Thank you for watching this introduction to financial principles. Understanding these core concepts is essential for making informed decisions in any business environment.